Hello and welcome back to another edition of Lipper's Fund Flows Insight. I'm Matthew Lemieux. We're going to be looking at weekly flows numbers for the week ended February 13th. So here we are 2 weeks into February, and so far so good when it comes to the markets. We've seen good positive returns in most of the equity markets, specifically here in the U.S., as well as the big story has been investors focusing on reallocating some of their cash towards equity mutual funds. And so far this week, it was a similar story. We saw a little bit of a pop in the market at the end of last week, coming off of good economic news here, as well as good export news out of China. But really ever since then, we saw the markets move somewhat sideways. I think some investors may be waiting for some additional news or signals to see if this is going to continue on the path it's on. There's a lot of analysts out there, as well as fund managers that we've heard from, that may think that we're kind of in a good territory for a correction. Others continue to see that we're going to be going on our merry way upwards. So I think there's a little bit of a pause in at least the markets when it comes to prices. But let's take a look at how investors have reacted to that for flows. If we actually look at the overall macro groups, we see that with the four macro groups combined, overall we saw $3.4 billion in outflows. Once again, really skewed by money markets. Money market funds saw $9.7 billion. You exclude those, we had actually $4.4 billion in positive inflows. 2.4 of that going to equity, 2.9 to taxable bonds, and municipals put in about $400 million for the week. So let's talk about the first group, which really kind of been the focus so far this year, which is equity mutual funds. Again, as I'd mentioned this week, $2.4 billion coming to this group. It's the sixth consecutive week of inflows into this group, and if you look at it on a year-to-date basis, we've seen $44 billion going to equity mutual funds. So far so good. When you look at the split though, something may catch your eye. Traditionally over the last 5 weeks we've seen that we have a good split between domestic and non-domestic, but this week actually domestic funds had about $600 million in outflows, which may concern some people, but I think really what it is some selective selling. We've heard a lot of this concern, as I mentioned before, about are we at a top? Maybe this is a good time to take some profits off the table. But non-domestics continue to do quite well with $3 billion in inflows. If you look at them on a year-to-date basis, about $20 billion so far into domestic, about $23 billion so far into non-domestic, so pretty evenly split across the board. Emerging market continued to be the driving factor for the non-domestic side, as we saw about $1.6 billion go into that group. So let's take a look at the ETF side and see if there's a big contrast there, and which there is. We have seen in basically 4 of the 6 weeks, both of these groups kind of moving in tandem upwards. But again, we saw equity ETFs have net outflows for this week, about $1.8 billion. Also, again, it was really on the shoulders of movement in SPY, Spider S&P 500, which gave back $2.3 billion. And we also saw about $1 billion in outflows from PowerShares QQQ. So again, I think some investors out there taking some profits off the table. It could be also some institutions that really built up on these products toward the end of the year, reallocating some of this passive money to maybe more active strategies. But overall, if you look at the larger equity group, including mutual funds and ETFs, we've seen roughly $67 billion go into this group so far this year. And if you look at just the January numbers that we finalized, about $60 billion, largest January we've seen on record. So overall, things are good in the equity fund space. So let's go on to the second group, which is taxable bonds. Taxable bond funds, again, brought $2.9 billion in for the week. Really on their merry way. We've continued to see inflows into this group for some time. This is actually the 15th consecutive week of inflows into taxable bonds, but the underlying strategies that are really attracting these assets is somewhat different. Traditionally we've seen money mostly going into investment grade. We've also seen some short-term interest here and there into high yield. This week it was really bank loan products. We saw $1.2 billion going into bank loan products. This is the 35th consecutive week for that group, but also the largest week on record. So investors are really going towards this product for yield, but also maybe for some interest rate hedging for risk. If you're worried about interest rates going up, this might be a good product for you. So bank loan funds have really gained some steam. International and global debts also have done quite well, $794 million. Again, really coming off the emerging market side. Emerging market debt and emerging market debt local currency products have been bringing in a lot of the assets there. The third group I would mention is intermediate investment grade. This is really kind of a smaller look at some of our Lipper classifications. This is the largest taxable bond fund classification we maintain, about $880 billion in assets, and we saw $1.4 billion come out of this group this week. largest on record. So again, maybe a little bit of weakness in the bond space in investors' view. Again, it also may just be with not just the rising interest rates we're seeing on the Treasury side, but also just the attraction of equity and everyone kind of moving to that direction. So we'll have to really keep an eye on that group, since it is really the catalyst of the larger taxable bond space. So let's go on to the taxable ETF side. And again, it's a much smaller group, but we saw about $397 million come into this group, kind of mixed across the board. One of the couple of the products that did stand out were high yield ETF products. Overall, we saw high yield ETFs have outflows of $437 million. Mainly on the shoulders of HYG and JNK. We did have some short-term high-yield buying in that group, but overall, high yield was not doing quite well. We also saw some money coming out of Treasury, so kind of mixed within that group. Third group we're going to take a look at is municipal debt. Municipal debt, as I mentioned, about $400 million coming in. We really haven't seen the same volume of inflows into this group. It's kind of been mixed so far this year, but investors still feel confident in the muni bond space. Of that $400 million, we saw about 403 going into the national muni space, while a subgroup of that was high yield muni, about $101 million. So investors still looking and interested in the high yield tax exempt space of muni debt. Last group we're going to talk about is money market funds. As I mentioned before, $9.7 billion coming out of this group. It kind of skewed the overall numbers for the conventional fund business. If you actually look at the split out, it was really quite even between institutional and retail. Institutional pulled about $5.6 billion, while retail pulled about $4.2 billion. So again, all arrows are kind of pointing towards people putting money towards risk, whether you're on the institutional side or the retail side, really not wanting to keep cash on the sidelines, especially when it's really not giving you anything and actually has mostly zero real interest rates. So putting it to work elsewhere, and maybe we'll continue to see that if we continue to see optimism in the market and money going towards risk assets. So what are we going to be looking for going forward? Well, we're kind of sitting at the tail end of the earnings season. When we look at the most latest reports, we saw about 75% of the S&P 500 companies have reported better than expected earnings, which is much higher than the average. But we've also seen a earnings growth rate of about 5.2%. So I think most investors are feeling pretty happy about that. Overall, I think what they're going to be looking for is some continued good economic news in the market, but also in the back of their minds, they're still going to be thinking about policymakers here and abroad, and whether they're going to have any adverse effects on the markets. As we had just this last week, President Barack Obama had his first second-term State of the Union address, where he laid out some very ambitious plans. It seems at this point that there's some lukewarm response to that in Congress, so I think a lot of people may be preparing themselves for business as usual in Washington, while also keeping an eye on other policymakers overseas. So if you really want to kind of get a deeper dive into this data or get a little bit more information about it, you can visit our website at www.lipperusfundflows.com. Otherwise, you can just join us back here next week when we go over the flows. So once again, thank you. My name is Matthew Lemieux, and thank you for coming to Lipper's Fund Flows Insight.